How to structure your trading portfolio for success. A well-structured trading portfolio isn't just a spreadsheet filled with tickers. It's a strategic blueprint for long-term success. Whether you're a retail investor or a seasoned trader, how you organize your assets determines your ability to survive volatility, capitalize on opportunity, and grow wealth over time. One of the primary purposes of portfolio structure is risk mitigation. Poorly managed portfolios are vulnerable to drawdowns that can erase months or years of gains. A diversified and risk-adjusted portfolio helps protect your capital from market shocks. Your trading portfolio isn't just a collection of random stocks, forex pairs, or crypto tokens. It's a reflection of your strategy, mindset, and long-term vision. Having a well-structured portfolio helps you control risk across different markets and timeframes. Allocate capital effectively based on your edge. Avoid emotional decision-making. Adapt to market changes without panic. Think of it like building a house. Without a blueprint, you're just stacking bricks hoping it doesn't fall apart. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use code BLOG to receive 25% off your next purchase. Before choosing what to trade, you need to know why you're trading. Are you looking for short-term income? Long-term growth? A side hustle while working a 9 to 5? Your structure will depend heavily on your purpose. Also ask, are you a day trader, swing trader, or position trader? Day trader. Focus on highly liquid assets like SPY, QQQ, or major forex pairs. Swing trader. You might mix stocks, ETFs, and maybe some crypto. Position trader. You'll likely hold assets for months, so quality and fundamentals matter more. Know thyself, and build accordingly. Are you trading to generate monthly income or grow wealth over 5 to 10 years? Short-term goals lean on active strategies like day trading, while long-term goals favor swing or position trading. Assess your risk appetite. Can you stomach a 10% drawdown? What's your investment time frame, 1 year, 5 years, or longer? This will determine your portfolio allocation and strategy mix. Before constructing any portfolio, you must first define your trading goals. Are you aiming for short-term capital appreciation, steady income, or long-term wealth accumulation? Once objectives are clear, assess your risk tolerance, which will directly influence your asset allocation decisions. Aggressive traders may lean toward equities, high volatility instruments, or leveraged products. Conservative traders might prefer bonds, dividend stocks, or even cash equivalents. Balanced traders often seek a hybrid approach, combining growth and stability. Understanding your trading style, whether we're day traders, swing traders, or position traders, further helps refine how we structure our portfolio. The Core Satellite Strategy is a powerful framework that combines stability with growth opportunities. Core holdings. These are long-term, low-risk assets such as index funds, blue-chip stocks, or bond ETFs. They should comprise 60% to 80% of your portfolio. Satellite holdings. These are high-growth or speculative trades such as small-cap stocks, crypto, or leveraged ETFs. These positions are more actively managed and should make up 20% to 40%. This approach ensures that your portfolio maintains a strong foundation while allowing room for strategic growth trades. Too many new traders think diversification means buy a little of everything. Smart diversification is about spreading your risk across uncorrelated assets or strategies. Here's a golden rule for you to follow. 3 to 5 strategies max, each with a clear edge and risk profile. Example portfolio structure. 40% swing trades in US stocks. 20% options trading with defined risk. 20% short-term crypto momentum plays. 10% long-term positions in ETFs or having a 10% cash buffer. This kind of layout gives you flexibility, exposure, and a cushion for rough markets. This is one of the most searched questions online, and it's crucial. The golden rule. Never risk more than 1 to 2% of your trading capital on a single trade. Let's say you have a $10,000 portfolio. That means your max risk per trade should be $100 to $200 max. This keeps you in the game when losses happen. More importantly, it prevents a few bad trades from blowing up your entire portfolio. Pro tip: use stop losses religiously and adjust my position size based on the volatility of each trade. To build a trading portfolio that delivers consistent returns, you need more than just good picks, you need a solid allocation strategy. Here's what works. Have a core satellite approach, which consists of 60% to 70% low-risk trades, ETFs, index tracking. Satellite, 30% to 40% high-reward plays, crypto, small-cap momentum, short-term setups. Allocate more capital to strategies with a higher win rate and proven edge. Reduce exposure to experimental setups until they're proven. Track each strategy separately. Example, have a trading journal for swing trades, one for options, and one for day trades. People lump all trades into one bucket. Don't do that. Beyond asset class diversification, traders need to ensure your portfolio spans various economic sectors and global markets. This helps reduce correlation risk, where multiple assets decline simultaneously due to common exposure. Sector allocation examples: technology, healthcare, finance, consumer discretionary or energy. Geographic allocation examples pertains to the US markets, example the S&P 500, emerging markets like India and Brazil. Developed international markets, such as those found in Europe or Japan. A global, multi-sector allocation protects against domestic downturns and opens opportunities in underperforming or emerging regions. Let's be real. Markets don't stay the same forever. So how do you adapt your trading portfolio when conditions shift? During high volatility, reduce position size, raise cash levels, favor options with defined risk. During trending markets, scale into positions, lean more into swing setups. During uncertainty, play defense, focus on risk management more than returns. The goal isn't to predict every move, it's to stay nimble and emotionally neutral. Liquidity is crucial for both trade execution and risk mitigation. A successful portfolio includes a portion of highly liquid assets to ensure we can adapt quickly to market changes. Cash or cash equivalents of about 5% to 10% are ideal levels. Always maintain some dry powder. Liquid ETFs or large cap stocks are some of the easier instruments to enter and exit. Avoid illiquid instruments unless they represent a small, speculative slice of the portfolio. Staying liquid allows us to respond to opportunities or threats without being forced to sell core assets at a loss. Track and review your portfolio. This one's underrated but incredibly important. You can't improve what you don't measure. Here's how to track your portfolio. Weekly performance reviews. Win rate by strategy, risk, reward ratio average, journal entries for every trade. Tools like TraderSync, Edgewonk, or even a simple Google Sheet can work wonders. By doing this, you will be able to eliminate low-performing strategies and double down on what works. Include crypto. Crypto is fast, volatile, and potentially rewarding. But it can also wreck your portfolio if you overexpose yourself. Here's how you should do it. No more than 15% to 20% of your total portfolio in crypto trades. Only trade liquid coins with a clear pattern or trend. Set hard stops and avoid chasing pumps. If you want to structure your trading portfolio for success, don't let FOMO, fear of missing out, guide your decisions. Let math and planning lead the way. Conclusion: there's no one-size-fits-all answer to how to structure your trading portfolio for success. Simplicity beats complexity. Risk management trumps return potential, and clarity brings consistency. If you're struggling, don't be afraid to start small. Focus on one or two strategies you can execute well. Build from there. And above all, be patient. Mastery takes time. You're not just building a portfolio. You're building a system that supports your financial future. Thank you for watching.